Asset-based finance is broken down into three specific products: factoring, invoice discounting, and asset-based lending. Factoring is the oldest established of all the products and has been going for hundreds and hundreds of years. Basically, if you're a small business and you're waiting for your customer to pay, let's say you're buying and selling glasses, you sell the glasses to Marks and Spencer's, for example. Marks and Spencer's will take 50, 60 days to pay. There's a cash flow gap that needs filling. If you factor your invoice, you sell your invoice to a factoring company, that factoring company will give you 80 or 90% of the value of those invoices up front, so you can go and buy more glasses to sell to Tesco's, for example. Once Marks and Spencer's have paid, that remaining 10 or 20% is paid across to you, less the charges for the factoring. Invoice discounting is very similar to factoring, but is predominantly used by larger businesses who have a more sophisticated credit control and collection procedure. The process is exactly the same in terms of providing working capital, but in factoring, notification is made by the finance provider to the customer, instructing the customer to pay them direct. In invoice discounting, the relationship is completely undisclosed and confidential, and the customer has no knowledge of the relationship between the supplier and the provider. Asset-based lending, within the broad concept of asset-based finance, is the means by which a business can absolutely maximize its cash availability by using all of its assets. So whether it wants to buy another business, whether it wants to grow, whether it needs to restructure, by taking all of the assets in a package, the invoice finance and asset-based finance provider is able to maximize the amount of cash that business can get. So all the assets, for example, stock, plant and machinery, even the premises, can be used as part of the package in addition to invoice finance to enable the business to achieve its long-term growth objectives. Invoice finance is available to any business as soon as it comes into existence, as soon as it has an invoice that it can sell to an invoice finance funder. The issue predominantly for smaller businesses is that they don't have the history, they don't have the background that they can show how well they run the business, how the sales ledger works, how profitable they are. And so the safer product for an invoice finance provider is to let them have factoring. But it does mean that product can be provided to any business as soon as they've started trading. The factor will get involved in assisting that business by giving credit control, helping them with collections, and there's a lot to be said for assessing the worth of the customers that you're going to deal with. And many of our members will also provide bad debt cover as well, so that new business can start trading with customers in the knowledge that if those customers fail, it won't bring them down. Invoice discounting becomes more appropriate as a business grows, as that business has a track record in terms of the way it manages its debts, in terms of credit control, collections, and profitability and overall management. And we've seen that some small businesses start on factoring, move to invoice discounting, and ultimately some of those businesses become household names, and they continue to use invoice discounting because it's the most appropriate product for them. Yes. Asset-based finance and invoice finance is provided by a range of businesses, from the clearing banks to challenger banks to foreign banks and to a range of independents. And the products can be offered not just within the UK, but cross-border facilities can be provided too. Of course, one of the key things for us is to look at the debts and the quality of the debts, the quality of the customers, the range, the spread, etc. And that's a big focus, because by and large, that's the main asset against which we're funding. Invoice finance is relatively quick to put in place. I know I've been involved in situations where it's been done within 3 or 4 days. But typically you're looking at probably between 2 and 3 weeks for a small facility, perhaps a bit longer if you're getting asset-based lending involved and looking at all the assets of the business.